Good afternoon, everyone. It gives me great pleasure to introduce Capco Institute's webinar today on the technology in insurance. I'm James Arnett. I'm the managing partner of Capco Asia Pacific. Capco is a management consultancy focused on technology purely in the financial services sector. We have 6,000 consultants globally, and we are recently joined the Wipro family, an acquisition that was completed in the spring. Today, we have a keynote from Professor Joe Peppard, Principal Research Scientist at MIT Sloan School of Management. Following the professor's presentation, we will have a panel debate from an esteemed panel of Bryce Johns, Group General Manager, Global CEO of HSBC Life and Insurance Partnerships, Jon-Paul Johns, Regional Chief Operating Officer of APAC Allianz, and Sachin Shah, General Manager, Emerging Markets of Manulife. There will be an option for you to add questions as we go through the presentation, and we will answer the questions either through or towards the end of the session. Now, I would like to pass over to Professor Joe Peppard for his presentation. Thank you, everyone.
Great. Thank you very much, James. So what I want to present to you, it's your afternoon. I'm actually coming to you, I should say, from Dublin, from my home office here. So it just shows the power of technology and what it does enable us to do today. But what I want to do in talking about the implications of new technologies on the future of the insurance industry is present possibly a different perspective. I would imagine that what I'm going to present to you is probably not what you're expecting in respect of a session that's going to focus on the implications of new technologies. And I think that hopefully will become clear as I progress through the next 25 minutes or so, because I do believe that when we talk about technology, when we talk about disruption, that we get very much caught up in the hype around technology. And we forget about really what is it that technology is bringing to us in terms of an industry, but in terms of possibly the new capabilities that it's enabling. And it's these really new capabilities that we should be focusing in on, not on technology itself. So I suppose what I want to do is to begin with a little bit of a kind of a health warning. And that is that, I do not claim to be an expert in insurance. And I'm sure that, some of you at least attending this webinar have probably got, a quarter of a century or more experience working in the industry. But actually, I have been a board member, indeed, former chairman of Phineas Corporation, who is a kind of a global provider of kind of core systems for life, accident, and health insurance. So coming at it from my board position, and I do have a good understanding of the dynamics within the industry. I'm also not a technology futurologist. As you're probably well aware, there are people who actually have that job title. And I do know, Allianz, for example, I do know, for example, have, people that explore tech and industry impacts. And also there's a lot of more resourceful consultancies that have all produced reports on technology and the impact that technology is likely to have on the insurance industry. And I'm trying to think, what can I add? So obviously early on this month, there was the big InsurTech Connect conference in Las Vegas. Some of you may have attended that. And these are some of the reports that, some of the major consultancies have produced over the last 12 months or so. I think particularly our colleagues from McKinsey's have been particularly busy in terms of the work that they've been doing, looking at the impact of technology on insurance. And indeed, Capco have also produced their own reports. But I think where I can add something to the conversation is around information, innovation, and business models. Because at the end of the day, insurance and what you ultimately sell, or the service that you deliver to customers and clients, is essentially it's an information product. And if we talk a lot today about, customer experience, for example, and really when you peel back, what is a really great customer experience? It's how the organization that's providing that great customer experience chooses to work with, harness information. We're seeing information, reshape business models. It's, information that determines organizational efficiency and also organizational complexity. And we see information totally redefining industries. I can remember many, many years ago, it's probably 25 years ago. Some of you, that may be familiar with what happened in the UK back then. I was talking to one of the board members of British Gas, as it was at the time, and they had launched a credit card. And I remember asking him, why would a utility that effectively sells gas, want to, get into financial services? And what he said to me was, that the gas company actually had more information about the customers of the banks than the banks did about their own customers. And I think, again, it gets us to rethink the nature of industries, because if we redefine industries by the amount of information that a company has on customers, therefore the boundaries, the traditional boundaries will be challenged. And of course, now we've also seen new business models emerging and in insurance, particularly around predict and prevent and ecosystems. So this really is where I think I can maybe add something in addition to the conversations that I'm sure that you are very, very familiar with. I want to take you back. I want to take you back to 1985. Any of you that have done an MBA program may be familiar with this article. It was written by, at least co-authored by Michael Porter, which I'm sure most of you are aware of his work on value chains and five forces analysis. But he wrote this article that was published in Harvard Business Review called, How Information Gives You a Competitive Advantage. And despite the fact that it was written in 1985, 36, 37 years ago, I believe that it's got very, very strong resonance for organizations today. And let me just quickly read through the first paragraph. What Michael wrote was that most general managers know that the revolution is underway and few dispute its importance. As more and more of their time and investment capital is absorbed in information technology and its effects, executives have a growing awareness that the technology can no longer be the exclusive terrain. And he used EDP and IS departments, probably the IT department or the digital department today. As they see their rivals use information for competitive advantage, these executives recognize the need to become directly involved in the management of the new technology. In the face of rapid change, however, they don't know how. And I believe that that is still the case today in the majority of organizations, not just in insurance, but I think in organizations in general. But I think for me, the key line of this article is the next sentence, where he says, this article aims to help general managers respond to the challenges of the information revolution. I think that, again, there's a lot of great technologies out there, and I'm sure we're going to talk about some of them today. But I think we, again, as I've already said, I think we tend to get caught up in the hype of technology and to see what's happening today as a technology revolution. I firmly believe that we are in the midst of the information revolution, a revolution that began over 60 years ago. So I think despite the tremendous advances that have been made in technology, and they have been massive, particularly over the last decades, it's really about information, not technology. And that's really what I want to maybe explain a little bit about my thinking and reasoning before I then kind of get into a little bit more detail to give you a framework to perhaps think strategically about harnessing information. But let's look at some technologies that we see impacting insurance today. And I've got just a list here. I could have put drones, for example, as another technology that, again, I think is impacting the insurance industry. But if we look at technology, no matter how complex, how sophisticated that technology is, essentially what technology does is it's essentially bringing five capabilities to organizations. That's all, 5 capabilities. You know, it provides the capability to collect data, to transmit data, to store data, to process data or to manipulate data, and to present it. Okay, some technologies, you know, just provide one capability, like, you know, like sensors, for example, provide a capability maybe just to capture data. Other technologies may provide a number of those capabilities. But really, when we look at technology, you know, it's really just a limited set of capabilities. But we are only limited by our ingenuity, by our creativity in terms of how we choose to harness those capabilities. So, you know, on the slide, I've just listed out some technologies. AI obviously is one that is definitely having a big impact on the insurance industry. You know, 5G, Internet of Things, you know, serverless computers, blockchain, and just to look at maybe at some of the capabilities. You know, if we look at, let's say, you know, natural language processing, you know, it's obviously around speech and text recognition or image recognition is all around about, you know, the capture of data from images. You know, the Internet of Things is really a combination of different technologies, you know, sensors to enable data to be collected, some mechanism then to transmit that data. And obviously then we need to store and have the ability then to manipulate and draw some conclusions from that particular data. You know, quantum computing, obviously you know, again, it's very much in its infancy, is likely to have tremendous implications in the future, particularly around its ability to process large data sets. And then just to look at some of the applications, you know, with AI, we're looking really here at augmenting humans. So it's speech and text recognition, for example, through natural language processing. It's, you know, through bots, for example, or customer engagement. You know, we know with image recognition, the ability to, you know, use images as the basis to capture data. So with let's say the first notification of loss and for prevention. You know, 5G and the capabilities that technology provides around, you know, for telematics, for prediction, for providing on-demand services. So I'm sure most of you on this call are probably very, very familiar with these technologies. And I really just want to maybe just add a little bit and say, really look at the capabilities that it provides in terms of its ability to collect data possibly, or to collect and transmit, or collect, transmit, store, manipulate, and present. We just very, very simple set of capabilities. But as I said, we are limited by our ingenuity in terms of how, as an organization, we choose to harness them, both operationally and strategically. And really, I want to focus on those 2 points, operations and strategy. And I think operationally, if we look at organizations in general, and we look at this word complexity, and I know from the work that I've done with insurance companies, and indeed companies in general in financial services, there's a lot of complexity. And I think one of the biggest causes of complexity is how an organization chooses to harness and chooses to deploy technology in order to manage that information resource. Just a story, and this is a number of years ago, probably about 15, 16 years ago, I did a piece of consulting work for ASDA. And I remember having a number of conversations with the finance director, Judith McKenna. And one thing that she said to me that has stuck with me, and for many, many reasons, one of which, you know, was quite unusual to hear this coming from a chief financial officer. And what she said to me, and for those of you that don't know, ASDA is one of the big retailers in the UK. They've got about 600 stores spread right across both, you know, England, Wales, and Scotland. She'd mentioned that, you know, information drives this business, and anybody that's worked in retail would recognize that. But what she also said was that, you know, we as a company have made it very complex for a company that essentially buys and sells baked beans. So what she was saying was, you know, our business model is very, very simple. What we do is we buy in, you know, a container load of beans from Heinz, and then we split them up into individual cans and we sell them to customers. That's our business. But over the years, it's become very, very complex. And actually, the reason it's complex is how we have chosen to manage or indeed mismanage information. And obviously, this is where the technology comes into play. So operationally, information has a big role both in complexity, but also in reducing complexity. And let me tell you another story. This is a true story. It probably dates back 15, 16 years ago. And it was two US friends were visiting Paris. And they were spending a week in Paris, and obviously, there's lots to see. So they spent their days, visiting all the sites, all the tourist locations. And one of their friends had recommended that, one evening they should visit a particular restaurant. So they booked a reservation. And they got back to their hotel the evening or the late afternoon before the evening of the reservation. And they went to the concierge and they booked a cab to take them to the restaurant, because it had been a pretty miserable day in Paris. It had been raining all day. So at the appointed time, they came down, and at 7 o'clock in the evening, they came down to the reception area to pick up their cab. And there was no cab. They went to the concierge and said, you remember we were here, about an hour and a half ago. We ordered a cab. The cab does not seem to be here. The concierge then said, oh, let me just check, sir, and see what the problem is. And the concierge came back and he says, I'm very sorry, there's been some sort of a screw up in the cab company. And unfortunately, your booking was mishandled. And, it's a rainy night in Paris. You're going to have to wait another 45 minutes for a cab to arrive. Of course, the two tourists were pretty irate, and also they had a dinner appointment. So they decided, despite the rain, that they would walk to the restaurant. And as they walked to the restaurant, they had a bit of a conversation. And they sort of wondered, was the concierge being truthful? Had he actually booked a cab for them? Maybe he had. Maybe he hadn't, they weren't sure. Or maybe he had booked a cab and maybe the person who actually took the booking had somehow misplaced it. They don't know. But maybe they hadn't. Maybe the person who took the booking had recorded it accurately on the cab company systems. And maybe it was the dispatcher. Maybe the dispatcher just completely overlooked or forgot to dispatch a cab to the hotel to pick them up. They didn't know, but maybe the dispatcher did. And maybe it was the cab driver. As the cab driver was driving to the hotel to pick them up, maybe, again, it was a rainy night in Paris, lots of people were looking for cabs. Maybe he just picked up another fare and didn't bother to pick up the two tourists at their hotel. Nobody knew. So there was lots of information asymmetry here. Yeah, and anybody who comes from an economics background will know that information asymmetry exists when one party to a transaction has more or superior information to another. And of course, this conversation led these two friends to essentially think about, well, is there a business opportunity here? And that led them to establish Uber. And that's the story behind Uber. And I think the key point I want to make here is that the Uber sort of business model is really framed around information. It's addressing the challenge of information asymmetry. And the key point for today is that it wasn't using any technology that wasn't available to anybody else. It was really the idea. It was really the ingenuity of these two guys as they walked to the hotel. They recognized the opportunity that possibly could be afforded if they could address this challenge of information asymmetry. And they saw technology as being a way of doing this. So what I want to do is maybe just take this conversation a little bit further and look at sort of business models, because essentially Uber is a is a business model. It's a business model, what you might call a digital business model. It's shaped and framed by information. And we can look at business models, and particularly, and we're going to look at some insurance business models in a moment, by first of all, looking at technology and how, as an organization, we choose to architect our business using technology. And generally, we've got two choices. We can take that kind of traditional Porterian view of a value chain, or we can adopt what we typically call now a more ecosystem perspective. And let me just explain what I mean by that, and look at technology and the evolution of organizations and their design through the lens of the value chain and the value chain logic, and then secondly through the logic of of ecosystems. So in the days before computer systems, we go back to the time of General Motors, of Henry Ford, for example. Companies looked, to the extent that was possible, to become vertically integrated. Like Henry Ford, he actually, and the Ford Motor Company, as with General Motors and lots of the large corporations at the turn of the 20th century, they look to own what you might call the full value chain, to be totally vertically integrated. So Ford Motor Company would own the mines from which the ore was smelted that would provide the metal for the early motor cars. They also owned the forest, the teak forest, that would provide a trim for the cars, right the way through to the manufacturing facilities, the forecourts, and even after sales service. So it was all about pre-computer systems being vertically integrated to the extent that was possible. And primarily, that choice was driven around and driven by information, because of, and particularly the lack of information. Because if you had a supplier components into a manufacturing facility, if you did not have visibility into their manufacturing processes, if you did not have visibility into their quality control procedures, how could you be sure that when they would deliver components, if indeed they did deliver components as they promised, that it would be of the quality that you would expect it. So I think with this kind of vertical integration, very much supply side, it was all about economies of scale. There was a very, very high transaction cost as well. So transaction cost was very, very high, but the key asset was scale. And the focus was all about internal optimization, becoming as efficient as possible internally. No mention about the customer, of course. As we all know, Henry Ford famously said, the customer can have any color as long as it's black. And then, of course, when computers first appeared, particularly in the 70s and 80s, we talked about the unbundling of the corporation. Yeah. So you didn't need to do everything yourself. You could actually work with partners, and you could focus in on, as a business, what you would consider as being your core competency. Yeah, and these were something that were inimitable. They were rare. They were very, very difficult to copy. So now we shift from economies of scale to economies of scope. We reduce the transaction costs, and again, transaction costs are primarily due to information handling. We're looking to reduce information asymmetries, because again, if we think about just in time, which is a popular strategy in manufacturing, just in time is all about replacing inventory with information. So if you've got visibility into the inventory holdings of your supplier, obviously that gives you kind of that great comfort. It means that you don't actually have to have stock just in case, as typically was the case in the situation in the old model. But again, there the focus becomes customer value. So now we saw this right in the 70s up, organizations begun to focus more on the customer and their own particular core competencies. And this sort of has been this value chain logic that has been with us probably up until the last 10 or 12 years. And since then, now we've shifted more to an ecosystem logic. And an ecosystem logic, I suppose, is characterized by these platform companies. And now what happens is we sort of shift from supply side to demand side. This is where we kind of get the network effects. We've also got the inverted firm. So now value is created outside the organization. It's not created inside the organization. So you look at everything from Amazon through to Facebook, LinkedIn, the value is created by entities that operate outside, let's say, the core platform. Governance has obviously becomes a critical issue in platforms, in ecosystems, because as we see, the focus shifting from customer value to ecosystem value. And what you're trying to do is to eliminate information asymmetries, facilitate frictionless participation, and the key assets now are information and interactions. Just think about any of the major platform companies that you're aware of, from Airbnb to Uber to Facebook, any Amazon, what are their key assets? They don't have assets in the traditional sense of buildings and inventories. The key assets of these major platforms and these major ecosystems are information and interactions, and now focusing on ecosystem value. So that's that business architecture, the choices we make there. And then the other choice we need to is around knowledge of the customer, or indeed knowledge of the customer's assets, which I think is particularly pertinent and relevant in the insurance industry. Whether that's partial, so that we just know their name and address and maybe product holding, and that's about it. Or do we have a more comprehensive view of a customer, if it's in, let's say, in retail, let's say in P or property insurance for a consumer, like their house or apartment, for example, or in health, or do we have a comprehensive view? Do we have a really comprehensive view of a customer? And again, a comprehensive view is defined by the amount of information that we as a business have about a particular customer, or indeed about their assets. And what that does is that this enables us now to define sort of 4 distinct business models. And the first one I call is the bottom left-hand quadrant, the supplier model. And essentially, as a supplier, you sell through another company. There's obviously the potential for loss of power, because you're not actually selling directly to the end consumer, and you're a low-cost producer. And typically, innovation is incremental. A really good example here is Procter & Gamble. Everybody's heard of them, Procter & Gamble. You're probably not too aware of their brands, but I can be sure that this morning, when you brushed your teeth, you probably used a Procter & Gamble product. The problem is Procter & Gamble and that brand have really only partial information about you as a customer. Okay. And again, if I look at insurance, particularly in Europe, I know we have somebody from Allianz on the panel, but again, Allianz, sells a massive percentage of their business through agents, through brokers, through third parties. So, in terms of, the knowledge of the customer, I would argue that these third parties, agents, brokers, have a lot more information, a more comprehensive understanding of customers than Allianz does, because you're really maybe selling just a motor policy, whereas the broker maybe is also dealing with all of the financial dealings of that particular customer. The second model is kind of the omnichannel business. So again, this is where you still have the value chain logic, but you have a more comprehensive view of the customer. So the omnichannel business, you sort of own the customer relationship, probably providing multiple products through different channels. The customer can choose the channel, so whether it's an online, offline channel, whether it's mobile, desktop, face-to-face, tends to be, today context sensitive, particularly using, AI technologies, and you're looking at providing an integrated value chain. And there are lots of examples out there. One good example that I like is USAA, which is the big financial services company in the US. And typically, what USAA does is, they look to delight customers by life events. So again, we see the shift from selling products and selling policies to maybe focusing on customer life events. Recognizing that customer, yes, of course, the customer wants a mortgage, but really they're looking to buy a house. So that sort of logic, and of course, then that has implications when you think operationally, how do we organize ourselves operationally in order to deliver in this type of a value proposition to our customers? And that's something that we can come to in a moment. The third business model, where we're going to now shift the architecture across to becoming more of an ecosystem logic. But again, partial information on your customers, you're really the modular producer. So you're sort of got this plug and play sort of notion where you can adopt to others' ecosystems. So you have the likes of PayPal, for example, would be a very good, example here of a modular producer. PayPal can adopt to lots and lots of different ecosystems. But again, they only have partial knowledge of their customers. So for example, if you purchase, some books on Amazon.com, you use your PayPal account, all that PayPal will know is that you've spent 50 bucks with Amazon. They won't know, what you bought, was it a present, etc. They will have no information about that transaction. That information resides with the likes of an Amazon or these big platform companies. And I think, again, I think Allianz would be a good example here, where they can sort of plug into the platforms of other companies. So you buy a product and you click to take out insurance. That insurance can be provided by Allianz, even if it's white labeled. So again, they can also be a modular producer. And I think that this is one of the characteristics of, let's say, of digital. Whereas in the old physical world, very often thinking about strategy, it was all about choices about what you're not going to do. I think when we look at today's digital world, you can actually compete in all four quadrants, as we'll see in a moment. And then the final kind of quadrant is the ecosystem driver. So this is where you want to become the destination in your space. You look to ensure great customer experience. You have lots of customer knowledge, which you glean from the data that you collect from the transactions that all of your ecosystem partners will transact on your platforms. Again, you're looking to match customer needs with providers. You may not provide just your own products, your own policies. You may also provide complementary products and services, or indeed competitor products and services. And essentially, you look to extract a rent. So this is, you make a kind of a margin on facilitating the transaction. Obviously Amazon is a great example here. But let's say in insurance, in health insurance, Aetna in the US provider with their iTriage, again, is an example of a kind of a life company, again, looking to become an ecosystem driver via their iTriage service. So they want to become a little, an Amazon-like destination for healthcare. So they're sort of the four generic digital business models. And as I said, companies can compete in all four, or position themselves in all four. And we can begin to see some of the challenges that if you are, let's say, a supplier and you want to become an ecosystem driver, what it is that you need to do in order to get there, in terms of, obviously, you need to build up a more comprehensive picture of your customers. And for let's say, an insurance company that is in that bottom right-hand or bottom left-hand quadrant, if you're working through brokers and agents and other third parties, that can be quite difficult to do. And then in terms of business architecture, again, there's going to be particular capabilities, business capabilities, that you're going to have to begin to build, particularly around partnering, for example, if this is not something that you have traditionally engaged in. So let me kind of bring things to an end. As an incumbent, and I know most of you are coming from incumbent companies, we got to remember that technology changes rapidly. As I mentioned, over the last 10 years, even over the last 5 years, there's been tremendous advances in technology and technology capabilities. Just got to look at AI and what's been happening in kind of machine learning, for example. But technology changes rapidly, organizations don't. And I think that this, for me, is a big issue and a big challenge for organizations. How do you organize yourselves in a way that embraces new technologies and embraces the opportunities that technology brings to the industry today. And I think you know, when we talk about digital transformation, we tend to get caught up on the digital, the technology side, but the real big issue is on the transformation, the change. Technology changes rapidly, organizations don't. So I think, you know, there are some fundamental questions that go beyond technology. As I said at the outset of my presentation, it's you know, it's great to have a conversation about technology and to be wowed by, you know, what technology can do, and to have, you know, really great conversations about, you know, what might be possible. But I think at the end of the day, we've got to think, you know, what's the impact on our business model? Okay, that's the first one. I think the second one, which is for me is really, really critical, is how do we organize to embrace digital? How do we organize as a company to embrace digital? And I think this is not just saying, well, we're going to work in an agile way. And from the research that I've been doing, you know, what I see companies doing is they recognize they need to do something, but they're addressing the symptoms, not the causes of the problem. And I think that's a big, big issue, and that's a big challenge that organizations need to overcome. And then it comes back to the people, the talent, you know, the right talent and right mix of skills to understand technologies and the implications, and particularly their applications, and to use technologies. You know, there's questions around now, you know, do we build, buy, or partner? Because in today's highly connected world, you know, it's probably impossible to do everything yourself. And there's probably somebody out there that actually is better at doing what you're looking to do. So why not just partner? So I think that getting to that kind of you know, business architecture of a more ecosystem is probably you know, a valid route. And then how do we create resilience and sustain our business? So they're just some questions. So I think, you know, you know, we can have these great strategic conversations, which I know do go on, particularly at the upper echelons in organizations. But I think organizationally, as an incumbent in insurance, I think there are particular issues and challenges that need to be addressed in order to embrace digital and become that digital enterprise, to become that kind of that future ready position. So thank you very much. I hope that sort of maybe fueled some questions and a really good discussion.
Professor Joe Peppard, thank you very much for those insights around business architecture and the direction of digital strategy underpinned by data across insurance. Thank you. I'd like to just reintroduce our panel members today. So Bryce Johns, Jon-Paul Jones, and Sachin Shah from HSBC, Allianz, and Manulife, respectively. Thank you all. So topic number one today, COVID-19. Over the past 18 months, as a direct result of COVID-19, we've seen a fundamental shift in our day-to-day lives and how we do business. It's also changed the type of products and buying habits of our customers. Bryce, how has the pandemic and its response impacted future planning at HSBC? Has it impacted the use of technology or simply speeded up what you already had planned?
Thanks, James. And I think it's certainly reinforced our strategic direction and accelerated our execution in many times out of necessity. And I'll give a few call-outs, 4 of them actually. I think the first one is just the dramatic shift that we've all seen to remote ways of engaging customers. And by that, I'm not only talking about, you know, buying simple digital products directly, but also being able to offer access to complex advice and straight-through fulfillment via platforms like Zoom. And that's almost become the go-to approach that we have now sort of across the bank in terms of engaging with customers. And regulators actually were quite nervous about kind of getting into that space, particularly in the insurance arena. And so we saw that sort of quickly shift into a sandbox and then into a normal way of operating, probably a lot faster than it would have, you know, if COVID hadn't come along. I think the next theme for us is just the inextricable link that customers are making between wealth and health, and really kind of the understanding that these two coexist. You can't have one without the other. And that we're certainly seeing that our customers want to be digitally nudged engaged and rewarded, for lifestyle improvements, whether it's physical or financial, that they make. But a little bit like what the professor was talking about a bit earlier, that they're also wanting on tap integrated access, not only to cover, but to medical care and to well-being experiences. And so, we're very focused on trying to kind of bring all of this together on our digital core banking platforms, with the launch of our Well Plus and Benefits Plus and a lot of experiences in Hong Kong and in China. And certainly kind of whether you're an employer of an SME and you're thinking about your employees' well-being, or a retail customer, kind of those needs are the same. I think thirdly is just the we've definitely seen a high demand for high quality financial planning, and really we've seen that especially in China over the last 18 months with the clinical business model that we've launched there with salaried and scorecarded personal wealth planners, where we're offering an integrated approach to life, health, and wealth advisory in a fully digitally enabled way, and we're seeing customers really kind of value the professional experience that comes with financial planning. And then finally, and Jon-Paul, I see your background also a theme of sustainability, but I think kind of the whole theme of sustainability is obviously accelerated tremendously through COVID, and I think we're all trying to figure out how to leverage our scale to support a net zero future through the way we invest, the fund options we put in front of our customers, and the way we run our companies.
Thank you, Bryce. Sachin, in our earlier conversation, you emphasized the shift from pandemic to endemic. Why is that important? And how has that impacted your plans in terms of the technology capabilities, investments you are now focusing on?
James, thanks for that question. And it's great to be on the panel with Bryce and Jon-Paul Jones here. And I think this is an important topic for us. I'm sure it is for others as well, including the panelists here. But, I think about it simplistically. For all of us, I think we've been all waiting for COVID to end and to go away, if you will, and we all go back to normal, assuming we all remember what normal was from 18 months ago here. And this to me is really the biggest mindset shift that we need to make collectively, and certainly one that we're contemplating fairly hard at Manulife, which is with the pandemic, it's a beginning and end. Right? It began, we assumed it would go away. And in between there, we just had to kind of go into business continuity mode to kind of oversimplify it a bit. Obviously, there's been a lot of things that have happened and changed that are much more sustainable that we'll take forward with us. But we were all coming at this with a temporary mindset. And we've had great success because, as Bryce said, there's been a lot of tipping points reached because of what's happened here. So a significant portion of our business, more than 75%, is electronically submitted. Almost 100% of our product portfolio across all of our Asia footprint is now available through digital tools. And we have more than 70% of our business auto underwritten. So in that sense, these are things that'll go forward. But in terms of the actual business model and how we do business, how we interact with the customer, all we did was digitize it. And it's very prone to exactly what we've been experiencing, which is you have these waves of variants come, you have restriction movements as a result of that, and then you have economic shock that comes out of that. And nothing we've done over the last 18 months has really built resiliency to that. And that, to me, is fundamentally the big opportunity when we think about pandemic to endemic. Pandemic says there's a beginning and end. Endemic says it's here and we have to live with it, and that we will have variants, hopefully not many, hopefully not any, but we will have variants, and that's our planning assumption here. We will have restriction movements here, hopefully not for long, but it could be for a long time, as we've seen in Southeast Asia across the last several months here. And that the business model has to be rethought, and digital and all that we've made from a digital progress perspective is only going to help accelerate that. But we have to rethink, how do we acquire customers? How do we enable agents' productivity here? How do we think about product in this world? And equally importantly, how do we underwrite in a different way? Because we're still collecting the same data we were collecting before. We just now happen to feed it into a machine that automates it versus having a human look at it. So that's good news, right? But the bad news is we still got to collect that data, and they still have, in some cases, to go to a doctor or provide medical information or medical fluids that in a lockdown scenario become hard to provide, and often customers are reluctant to provide or even leave their homes in that type of scenario. So there is, I think, a real opportunity for us to rethink the whole model in an endemic world and accept that this will be endemic here. And that really, for us, is where we're putting a lot of thinking into how do we take advantage of this? I think we've taken advantage of the last 18 months. We've really pushed the digital tipping point with our agents, with our partners, with our customers, but we've really just digitized the current business model. And now it's an opportunity to say, this isn't going away. So how do we use it to really then take that next step and rethink key elements of our business model?
Thank you, Sachin. Jon-Paul, how far has the pandemic changed the course of your long-term plans? And from where do you want your organization to go? Has the pandemic played a role in streamlining your organization or the services and products it now provides?
Thank you for the question, James, much appreciated. And thank you, Professor Joe, for the shout outs or call outs to Allianz in your slides, much appreciated. So for sure, the pandemic has caused havoc for all of us, I'm sure. But in terms of a company as Allianz, we've got a very strategic long-term transformation program that is enabled by technology. We're using what we call our Allianz customer model, focusing on how we provide our products and services to those customers and using the underlying tone of simplicity, digital, and scalable. So that strategic plan has always been there and is uninterrupted through the course of the pandemic. The pandemic itself, however, has forced us, like I hear from my peers here today, many short-term decisions have needed to be taken through the process of the pandemic. So we've made decisions quickly around what we do with our employee technology and equally what we do with our customer technology. Those faster decision-making requirements are really focused upon how do we have business continuity, how do we support our distribution partners, how do we support our customers, and how do we make our internal employees very capable through this period of time. So for customers, like we have heard from others already, it's around how do we get remote sales, how do we work with the regulators on adapting the processes and procedures to use technology and work in a virtual way. And I'm sure we've all introduced similar remote sales, remote servicing capabilities, or expanded what we already had in place over the course of the last 12, 18 months. I think one of the big advantages I'm sure we've all experienced is there was no option. It had to be adopted, it had to be embraced, and the speed of adoption that we've all been able to achieve is something that we shouldn't step back from, and it should become the norm moving forward, and we need to build upon that. But we've gone through change curves far quicker than we ever would have been able to without a pandemic. So if there's not many good things about the pandemic, but that's certainly one example of a positive. For our employees, equally, we've had to invest. Work from home, work from anywhere. How do you collaborate? How do you use these WebEx and Zoom and Teams things to actually, work as a team when, in many cases, we're hiring new staff, we're building new teams, and they never get the opportunity to actually shake hands and build relationships on a face-to-face level. So we've invested in both of these areas, and I would say we haven't lost sight in any way of our long-term strategy. That continues, and if anything, we've accelerated some of the enablers that we will have as an organization to continue that journey.
Thank you, Jon-Paul. I'm going to move on to topic number 2. Technology, moving away from the impact of COVID-19 to purely focus on technology. Bryce, during one of the briefing calls in preparation for the webinar, you discussed how the current environment insurance firms need to have both a microscope and a telescope. How do you pivot in the short term as an industry that is reliant on its in-person interactions and not allow it to impact sales, and plan for the long term, bearing in mind the challenges posed by newcomers and new entrants into the industry?
Yeah, James, no, great question. I like the analogy there. I think kind of for us, it really sort of intersects in a hybrid way of engaging customers, which we believe, whether you're an RM in a bank or an agent in the field, I think will be the same for all of us. And that's kind of, our digital platforms kind of provide the opportunity for us to be able to engage and start a conversation with the customer, and then be able to connect that customer remotely, to an advisor that can run through sort of financial planning, is able to kind of then pivot that into a kind of a product sale, and then a service experience and an ongoing on an ongoing rewards platform. And I think sort of all of that coming together digitally for us in the bank's kind of core mobile banking app sort of becomes the platform that we're able to kind of operate off, both in the short term and in the long term.
And following on to that, Bryce, how do you see technology companies in specific fintechs, or do you see them as potential partners or competitors? And how do you view them against the larger tech companies as well?
Yeah, sure. Like I definitely say we see them, I guess, in both aspects. I think a lot of the fintechs and the insurtechs have really built some very slick front end customer experiences, particularly in the P&C space, and then in areas where the products and needs are quite simple. I think kind of from our side, as a competitor, we're sort of privileged on the other side to have a wide set of existing customers. Acquisition costs, as a lot of the kind of the newcomers are finding, is really difficult to kind of get customers onto your platform in the first place. We have the data and the analytics that enable us to kind of create personalized insurance experiences and underwriting experiences, Sachin, to the point that you made earlier, that we can make use of at outset, as opposed to having to acquire it. And then particularly, the balance sheet, underwriting know-how, and brand and reputation. I think we've seen a really kind of three kind of key tenets that our customers value, particularly when it comes to topics like legacy and estate planning and saving for retirement. Where you have investment products with guarantees, large health coverage, and curating health experiences for customers. And I think, for example, a lot of our customers would see HSBC as a brand and would trust the health experiences that we put sort of in front of them, and that becomes quite critical, particularly in the space of health and wealth. So that maybe just some thoughts on the fintech side. I think obviously we're partnering with fintechs. All of us are partnering with fintechs in many areas, building our platforms. In the employee benefits space, we worked with a health tech, CXA in Singapore in the early days. We've partnered with Dakadu as we bring a lot of health and well-being know-how to the table in terms of health score engine that we want to use for behaviorally rewarding our customers go forward. We spoke a little bit earlier around remote advisor onboarding in China when we launched our Pinnacle Planner business through COVID. A lot of the onboarding, not only of our staff, but of our advisors, was done kind of fully remotely. And actually a lot of that has kind of shifted to probably just a perpetual remote experience. Telemedicine, or ecosystem access for advisor leads generation. So, we see kind of partnerships in many different spaces, with fintechs. And then obviously the large players, and I'll just use our Pinnacle experience in China again, where we worked with Tencent and AliCloud in terms of setting up our mobile sales tools on the cloud, and Sinosoft, a local tech player, to build the platform for us. We were able to get this Pinnacle business up and running in about 6 to 7 months, starting from kind of ideation to actually kind of going live. And today we have 450 planners in 5 cities. Now, if you said to us 2 or 3 years ago, could you launch a financial planner business from scratch in 6 months? That's kind of fully digital and quite differentiated in this experience. We probably all would have laughed. And then if you had said, do that in 6 months and do it through COVID, where everybody's working remotely in different cities across China and in Hong Kong, and you build a business that's physical virtually, we all wouldn't have thought that was possible. So I think kind of, the cloud-based technology and the types of players that are out there are enabling people to kind of get going, a lot faster and at scale as well.
Thank you. Jon-Paul, what does technology mean for the industry in Asia, and what pain points do you expect technology to solve going forward?
Thanks again, James, for the question on that. I think I just build upon some of the things that Bryce has mentioned here as well. So I think there's probably 4 key areas that we look at as being big changes, big advantages for technology in the industry. The first one, I'm going to reiterate the power of the cloud, and it's not what we originally understood the cloud to be in terms of the basics of compute and storage and those sorts of things, but I think it's also the fast access to consuming innovations that we can incorporate into our solutions for our customers. And the ability to consume, change, alter, remove, and keep adapting at a much faster pace than we've ever been able to do in the past. And obviously the fintechs and the insurtechs without the legacy behind them are leveraging this to their best advantage. And as insurance companies, we need to continue to leverage the capability of cloud as well. We've recently spent the time using the cloud technology advantage to launch the capabilities for KYC, for e-signature, for payment solutions, anything that will help us to really enhance our customer proposition and our operational proposition through the COVID situation. We've also started now to look at how we can do KYC through the use of video to again incorporate in the remote and hybrid working model that we will have. And equally, we've just celebrated the first birthday of our insurance company in Singapore, the startup that we established just over a year ago. Everything that we have built there is digital and it's cloud-based. We now have more than 20 products available. And we also have, in the first year of operations, we've sold over 40,000 policies. None of this would have been possible without the ability to grab hold of cloud and leverage that capability as is possible these days. The second thing I would say is, the technology drive for the future is around customer experience. And not only customer experience in terms of, pretty screens, but 24/7, 365 availability of all of the services. And in addition to that, the ability to understand the feedback from the customer and to be able to adapt very, very quickly, continue to improve the proposition and make sure that the customer satisfaction is retained and indeed improved. I think also with customer experience, we should not forget about the customer person interactions that are still vitally important, particularly in the insurance industry. There are moments of truth where dealing with a chatbot or another form of technology is just not appropriate. But what we need to do is apply the latest technologies that are evolving now to make sure that those person-to-person interactions are truly of value. And we have all of the information that's needed to make those very, very efficient communications at the moment when they're most needed. Another point that was raised earlier and part of Professor Joe's presentation, totally agree on the ecosystem aspects of the future. I've no doubt that this is something that all of us on this panel are participating with and exploring further. There's a huge emergence of these digital ecosystems through the Asian markets and a great opportunity for how insurance can have access to data, access to customers, and also be incorporated into a much broader proposition. And then last but not least, I think what has become the norm now as we've gone through the pandemic period, it's all about mobile. It's no longer paper and wet signatures, everything is mobile, and the expectation that we need to address moving forward with our consumers and our distribution partners is the digital and mobile are the way forward. So I think some ideas from myself in terms of where we see key areas of focus and what technology is going to mean for the industry ahead. Thanks, James.
Thank you, Jon-Paul. That connects to my next question for Sachin. As part of your move to a great use of tech in your interactions, where does the digital ecosystem partnership sit in your plans for managing the customer data black box?
Thanks for that question, James. I think maybe to start a bit from the customer perspective, and for us, most of what we do today is what I call reaching the mass affluent and above in most of the markets we operate in throughout Asia and certainly in Southeast Asia as well. Here and it's important to recognize who we're after and who we're selling to. And I would say the other side of this too, which has been quite a learning for us, is that the mass market consumer and purchaser of insurance has had tremendous economic shock particularly in Southeast Asia over the last 18 months. And we've seen this in terms of the experience we see with customers, lapse rates and purchase rates by segment. And in geographies all over Southeast Asia, I think in many ways the economic shock on the mass market consumers is maybe not this, doesn't get the story and headline it should here in many ways. But when we think about who principally we go after there, these customers still today, even in a COVID world, ultimately want some form of interaction. Now, obviously, a lot of that is beginning to take place virtually. And certainly in terms of the wet signature, as Jon-Paul said, all of that is moving to a much more of an e-signature, e-KYC type world there. So very important for us to recognize who we're selling to, how they prefer to interact there, and ultimately what that means in terms of the kind of partnerships we go after. I think about this strategy much more broadly than just the digital ecosystem piece. Obviously, the digital ecosystem piece is critical in many ways, but certainly in terms of how do we participate in ecosystems and increase our relevancy, right? I mean, insurance, for as long as I've been around, for 25 plus years in this industry, struggles for relevancy. We're not cool in any way whatsoever. We're not an iPhone. We're not the latest gadget. We're not the latest business class. And so relevancy has always been a challenge for us. And I'd say it's been accelerated by what's happened with the pandemic, because a lot of our relevancy was human to human. We had agents, we had partners, and even with our partners, and Bryce's business is a great example of that, a lot of the interactions there through a partner like HSBC are done human to human, or were done human to human pre-COVID there. So a lot of our focus around digital ecosystems is how do we expand our reach and increase our relevancy in a world where what was done human to human now is highly limited. Either because the customer chooses not to engage anymore because of health concerns, or the agent or partner is unable to access customers in a traditional mechanism. And so digital ecosystems for us, one, is a way of expanding our reach, increasing our relevancy there. The second piece for us behind that then is to, back to this point about, pandemic to endemic, giving the customer and the agent or advisor options on how they interact, and fully virtualizing the whole interaction, if that's the choice of both the customer and the advisor, and or giving some flavor of both, where parts of the interaction could be in person, parts of the interaction take place virtually, and a lot of what would have been the normal paper-based type activities are all now fully digitized, and in many ways, a completely different experience than just simply digitizing the paper piece of it. And it's all about the data capture there. The third piece for us is around underwriting. And I think this is where there's tremendous opportunity for us. And I personally feel like we're not putting enough of our own energy into this space, because it's not simply about how do we automate underwriting. I think we've all successfully done that to a large degree over the last 18 months. But it's much more about how do we completely reimagine underwriting from what data we use to do it. Particularly in a world where customers maybe don't want to give that data, or the way that data needs to be collected is just not going to meet the safety concerns or health concerns that we have. Using biometrics as an example, as a way to underwrite there. And also beginning to think through the product strategy. And this gets back to my point about the economic shock that the mass market consumers have felt because of the pandemic here, and it won't go away. As we have potentially new variants and then restriction movements, people begin to have income impacts. And they begin to prioritize where that money goes then for the next couple of months. And often for someone who's a mass market consumer, the insurance product may not be the priority there. And we need to be thinking about what value can we deliver to that consumer, even in that type of mode, beyond some of the obvious things that we've all done, including premium holidays there. So there's, I think, a tremendous opportunity for us around product strategy. And this one is one where we need to put a lot more energy into it and think well beyond just how do we take the current process and increase automated underwriting or bring in some new data elements here, but really fundamentally rethink product strategy here. So you could put all that in the digital ecosystem space to some extent, because there are ecosystem players that are looking at these various areas too. And we certainly are, if not partnering with some of those players, similar to some of the names that Bryce and Jon-Paul mentioned, we're certainly looking at partnering with those types of players here. But I think about reach and capability as sort of the two big things that we're thinking about when we partner with digital ecosystems, with our focus right now on reach. And I'd say we need to do a lot more work on the capability side.
Thank you, Sachin. Topic number 3, speed, rate of change, legacy systems, greater use of technology. We've touched on all of these already, but it's gone. The pandemic's been a catalyst for change amongst factors such as the rise of fintechs. Jon-Paul, do you think the rapid pace of change could result in overlooking important issues, such as local issues related to implementation of the new technology, capabilities, cybersecurity, or use of cloud in certain jurisdictions?
Thank you, James. Much appreciated. That seems like a good question for a COO. So most certainly not. This is definitely an area of focus we must keep abreast of. So whilst we're accelerating technology decisions, maybe investment decisions on doing them a year early, 2 years early, that sort of thing, or more holistically, certainly as a company, and I would no doubt expect the same for other panel members here today. There's no cutting corners. We're no startup. We've got history and legacy and responsibilities to follow. So we haven't cut any corners. We actually have embedded a lot of our controls processes into the selection of technology, whether it's making sure that the information security aspects of technology decisions and how we implement them are there, ensuring that we have resilience by default, not resilience as option or as an afterthought. It's part of the design and the implementation. And then, of course, the operational testing and the validation. So yes, we've had to be fast through this period of time. Everyone has to. But the worst mistake we could possibly make is by adding more fuel to the fire through the pandemic period and making some terrible mistakes with our implementations of the new changes. So strengthening resilience and security, I think, has been actually part of the outcome of the work that we've all been doing. Modernizing, removing legacy, improving our toxicity position, and generally moving forwards with modernization is helping us through all of these things. Like everyone else, I'm quite sure cyber risk is pretty much top of the agenda. It's not optional, it's here to stay, and it's only getting worse. So we've got to keep abreast of it and make sure that we don't get too relaxed. So thanks, James.
Thanks, Jon-Paul. Sachin, Bryce, would you like to comment specifically related to your expansion plans and how technology is influenced?
Yeah, sure. I mean, I think, James, as we mentioned, just in terms of some of the new businesses that we've been launching in China, the Pinnacle Wealth Planner business and so forth, I think, we've been able to partner with tech firms, cloud-based, and, build businesses and platforms a lot faster and a lot cheaper than certainly would have been the case kind of a few years ago. And that's very much going to be the approach as we go forward. Sachin, how about yourself?
Yeah, thanks, Bryce. And I think similarly, these very much part of our plan. We have quite a bit of evaluation work underway across our various markets. Where we've done the most work here and have some good success that we're building off of is in the health and wellness space. And I think Bryce made a comment about this, that for all of us, I'd say certainly for us here in the panel, but more broadly representing the universe of our customers here, this linkage between health and wealth has been amplified over the last 18 months. And this linkage between consumers wanting to be rewarded for doing things that ultimately improve both those positions, health and wellness, there has also been amplified. And we've seen this with the success that we're seeing with our own Move Health app, and how consumers gravitate to actually doing their steps every day because they know there's a reward or a discount or something that enhances ultimately what they receive from us in terms of the insurance value proposition. And that's where we've spent quite a bit more time around how do we expand that value proposition for consumers. We're an insurance company. We're not a health expert, but there's plenty of opportunity in the health tech insurtech, fintech space around bringing enhanced value proposition to the consumer. And they want this here. And they often, and I think in many ways, there was a lot of debate before COVID of whether they would want this from an insurance company. And I think for us, at least over the last 18 months, it's very evident they want it from us and they welcome it from us. And it really is in many ways a right for us to step in. And that's something we're beginning to do much more aggressively, is how do we expand that health and wellness proposition for the consumer. The final point I make is it's not uniform across Asia, as an example, or even across Southeast Asia. What consumers want in Hong Kong versus what they want in Vietnam in terms of health and wellness proposition and services is very different here. And so it's not about a one-size-fits-all approach. It's very much about localizing this to the market, but having the concept or common framework around that there is a broader proposition and a broader role we can play here beyond just the insurance offer that we have. And that's where we're spending most of our energy in terms of partnering and insurtechs, and recognizing that we're not going to be the expert in offering this particular type of proposition.
Yeah, Sachin, and just to build, I mean, I think you were saying, you know, kind of would customers value getting kind of that health access through an insurer? Probably it was even a tougher question around whether they would want to access health through a bank, right? And we've seen kind of also just, you know, really unparalleled demand for access to kind of health from a rewards and a wearables and a kind of behavioral kind of perspective, which has been really encouraging. And I think we'll be doing a lot of focus on how do we stitch our rewards platforms, our financing programs, obviously kind of partnerships with the likes of Apple and Takadu, the wealth side of our business and the insurance side of our business, and kind of land that in an integrated experience in the bank's mobile app. And that's certainly kind of been a big focus of ours. A lot easier said than done.
Yeah. No, and we've seen that with our banking partners as well throughout the region. And I think, Bryce, I'm sure you see this, you know, in many ways, insurance companies, I think for a long time, we were low on the trust spectrum there, and maybe banks were certainly higher than insurance companies, but relative to maybe the Apples of the world or whatever here. But what we've seen through this pandemic is that we've actually have tremendous loyalty and trust from the customer. And it is really that foundation that's creating this open door, if you will, for us to step in. They're expecting these services from us, whether it's through the bank or through us directly or through some partnership that we have here. And I actually think it's been refreshing. Having been around the insurance industry a long time, I got tired of the, you know, we're kind of, inefficient and where we don't have high trust, right? We've all been fighting that one for a long time. And I think the last 18 months has really begun to take some of those things and kind of turn them upside down in terms of assumptions and create new opportunities for us that we all have to kind of embrace now more openly.
Great.
Thank you. So now we're open to a slightly open Q&A. So please jump into the questions as you see fit. One observation, a regular conversation we have is around building from scratch versus building on top of legacy. How do you avoid building new legacies when it comes to replatforming?
I'd like to take that one if possible.
Please.
So it's a really good question. I think it's a problem that we've been facing for decades in terms of large-scale system replacement. And I think one of the things that has to be overcome is a concept of you buy a new system and you leave it alone. You don't need to feed and water it for any foreseeable length of time. You paid all the money up front. It should last for some time. Whereas you need to keep adapting the technology. Things are changing way too quickly, and there's way too many opportunities that are out there. So certainly what we are trying to approach this problem with is it's not about a one-time investment. It's about building a solution that you continue to invest in over the course of time. And that's continual upgrade, that's continual thought process in terms of how you adapt it each year, each quarter, bringing agile capabilities into the way in which you address that, of course, and ensuring customer feedback comes in. But another element that is vital is you break down the scale of huge scale monolithic system solutions and try to make them as componentized as possible. And that gives you the opportunity to not necessarily switch it all out, but where things become legacy and you want to change them, you're not changing everything, you're just changing component parts. So look, I don't think there is one secret answer to doing this, but breaking the problem down and making it a series of decisions that you can take over the course of time and a continual investment stream. Thanks, James.
Thank you, Jon-Paul. I have a question. It seems like the line between insurers and insurtechs is blurring, with insurers doing mass hiring into digital and some insurtechs moving into the digital insurer space. Where do you think this is moving towards, and what are the opportunities and pitfalls on both sides?
Maybe I'll jump into this there. I think a couple points, and perhaps it was Professor Peppard who had said this, and I think both Jon-Paul and Bryce have also made comments. It's hard for any of us to imagine that our business, and I think it's any industry that you're in, but I'd certainly say this about insurance for sure, that we're not, that we have to think of ourselves as a technology company equally as much as an insurance company here. And it's less about just partnering with insurtechs now, which might have been the case 5 years ago or 10 years ago, and you brought in insurtechs for specific aspects of what you're doing, or you're partnering with them to create access here. Fundamentally now, it's about the whole business and how we rethink it because of what technology can do for us and what we must do with it in order to stay relevant and competitive. So I think this idea that we're competing with insurtechs is perhaps oversimplifying what's really happening to the industry here, and that we are fundamentally having to re-architect our business model around technology. And those that do it well, I think will certainly succeed, and those that do it well at scale will definitely be the winners here. And that gets to the insurtech side too. Look, one thing about insurance, right, and we certainly are ripe for disruption, so I don't want to sound like we're not, but at the same time, the barriers to entry of this business are very high. It still requires a lot of capital. And that capital generally relative to any technology return is pretty low when you think about it. So, insurtechs exist because they don't have to put up that capital. And they're able to create a proposition that can sit on top of our capital here, or fundamentally, they wouldn't get the private equity investment or venture investing or early investing that they're getting there, right? We'd be having private equity investors come to us to put money into our business if we could create returns like that here. So I think we've got to recognize that it's not an either or here, and that both need to exist. But at the same time, we have to, as insurers, bring a lot more technology capability into our business end to end. And it's not just the people we put in our technology organization or department. It's every aspect of our business needs to have digitally savvy, data-oriented people. Whether you're an underwriter, a claims adjudicator, a salesperson, an actuary, or a technologist. These are skills that we have to have across our business for us to be able to be around 10, 15, 20 years from now and be a scale player as we are today here. So I think it's less about blurring of the lines and really understanding, I think, the fundamental shift that's underway in terms of how we have to think about our talent base and our business model overall. Bryce, JP?
Yeah, no, look, I couldn't agree more, and I love your comments, especially on talent and kind of the balance sheet kind of capital side. I'd add one extra to that as well, that I think a lot of the insurtechs today seem to be very focused on digital direct to customer without an advice component, right? And I really think what we're seeing over and over again is that kind of works in the P&C space. It kind of works in the very simple, small ticket size term insurance space. When it starts coming to larger discussions around retirement or around health, customers want to eyeball somebody, right? They may want to go and experience and research online, but they actually want to speak to a human. Could be virtually versus physically, and that game is changing, but they want to speak to a human for advice, right? What's going to happen to me if I get cancer? Where do I go? Who do I speak to? And will this product deliver? And they're also going to want to speak to a human at a point of need. And again, we see that we spend a lot of time thinking about that as a bank, where a lot of customers that don't have a relationship manager hesitate around buying a health product through a bank, because at a time of need, who do they speak to? They can't go to the branch, right? So how do you start creating, whereas an agent is that physical point of contact, right? So how do we start creating virtual capabilities to connect customers to people? And I think we're seeing in a lot of markets, Singapore and elsewhere, right, a lot of the insurtechs come in and really struggle to get scale. They're launching great experiences, but actually boots on the ground or virtual boots these days, and advice and balance sheet are two other critical components, I think, of succeeding over time.
Yeah, and certainly from what both of you are saying, it resonates with myself as well and what we're seeing. So certainly from a talent perspective, I think it's refreshing to see a huge transition from IT being in the back office and that cost center to IT being at the forefront, and to having business people as well as technologists equally wanting to learn and talk about technology and be able to be in a room where they can collectively work on how technology is going to operate and take things forward. So I think we've made some huge step forwards in that regard. Here at Allianz, it's in the veins of the organization for technology being at the forefront. And I think that's the same for probably HSBC and Manulife as well. It's a huge part of the proposition moving forward. So it's good to see. But training the talent, keeping them excited is always going to be the challenge when everyone's after the same.
So. Certainly interesting watching the data scientists take on the actuaries, Jon-Paul.
Exactly. Yes. Who's got the best model? It's. I think on that point, I always have said to the actuaries, you're actually data scientists, right? You just do it the old-fashioned way, right? I mean, ultimately, an actuary is a data scientist, right? And we just have to equip them and modernize them in terms of the techniques and tools they use, and they're no different than a data scientist would be. They're not to oversimplify the transition, but to give some credit to the actuaries.
Sachin, did you just suggest that us actuaries are from the Stone Age and need to be modernized? Did I hear right there?
Not quite far back as the Stone Age, Bryce.
So it was going to go into my next question around talent, but you were touching on it then, because we've seen over the last 12 to 18 months, actually the demand for talent. The British press is the lack of lorry drivers on a simple stage, right, in the UK. But the talent in financial services is probably an all-time high, or as high as it's been in the last 10 to 15 years. And obviously for organizations of your scale, how do you retrain that workforce? How do you give the skills to your current people so that they're right for the future?
Yeah, look, I think in that, certainly from my side, just very, very briefly, we've been putting a lot of emphasis on training, certainly in terms of agile ways of working and just shifting the way we deliver and land platforms and comfort with being a digital native. And that's an area, I guess, as a bank, we don't survive unless we can deliver experiences on the mobile app. So I think, Sachin, to your point a little bit earlier, the type of people we bring in, but also the training and the retooling, particularly in terms of just operating in very different ways, is key to our talent retention.
Yeah, similarly here as well, we've been putting an entire leadership team through a certification program to address skill sets such as agile, as well as technology drivers, technology capabilities, awareness, and how to apply. And then for the work, for the team in general, it's a case of giving them the right access to tools and providing time each week that can be dedicated to retraining and developing new skill sets, and providing them with learning paths that will help them to consistently develop the skill sets. But I think also we're all experiencing a very virtual world these days. So access to talent is changing. It's no longer you have to be in the same room, you have to be in the same country or even in the same time zone. The opportunity to truly work globally and bring the right skill set to the right virtual teams is something I think we've seen in the past, we've all worked with in the past, but now it's kind of moved on to steroids, and we've got the opportunity to really capitalize upon that. So.
You know, the only thing I'd add to this, it's maybe, and I'm sure Bryce and Jon-Paul would agree with this as well. I think it's equally important in terms of the broader proposition and what we're finding, and I see this with a lot of the direct interactions I have with not only our current employees, but potentially future employees as well. In Southeast Asia in particular, it's a much more younger population, and the idea that it's not only about the training, but that this is a growth-oriented business and company that I'm joining. And that's not about their own proposition, but more, is this company growing? What's their commitment to the market? Because I want to make a career here. And obviously, if the company's growing, then there'll be more opportunities for me. So positioning the company as a growth-oriented player and being very clear about your ambition in that market is important. And I'm just amazed because I don't think I was quite this savvy when I was younger in my career in terms of the questions I asked about who I was joining. I thought a lot about the job and the pay. And here, I'd say they think a lot more about the company, the aspiration, and then equally importantly, the role we play in the community, and ESG has really factored into this. And this is an important decision point for many of the people that we've come across, both in our existing employees and why they stay or why they leave, but equally importantly in terms of how we attract new employees into the company and our position from an ESG perspective. And it's a broad, it's not like they have one particular view about, it's not just about climate change, it's not just about diversity, it's the company's total view around ESG and how that manifests itself is an important decision point as well. So the retraining is important and certainly is, I'll call it an inside out view of how do we get the talent from point A to point B in terms of what we need. But the total ability to retain, attract, motivate is probably, I'd say, even more important, especially given that some of the talents that we're after, whether it's technologists or actuaries, as an example, they don't exist in abundance in many of these markets. And so there's real competition for this talent.
Thank you.
Sure. Yeah.
Professor Joe, we have a question for you. Do you feel insurers or financial services firms in general will be able to customize or personalize their products to the level of granularity that most expect or that they claim?
Sure, yeah. Can maybe just the previous question, can I maybe add a few comments on talent, given that working in education, it's obviously something that we are pretty kind of focused on and concerned about. I think if I look at your region, Southeast Asia, I think a really good example for me is what DBS Bank have been doing over the last 10 or 12 years, and I'm sure most of you are probably familiar with the DBS story. But I think that they recognized very early on that that if they were going to be successful in achieving their digital ambitions, that they would need to make a big talent play, and they again very early on tried to position DBS alongside the Googles, the Amazons, the Netflix, the LinkedIns of this world. So if a bright graduate student had an opportunity to work for a LinkedIn or a Google or a DBS, that DBS would be seen as a really attractive career choice for them to make. So I think the talent is and the focus on attracting what is a resource that is not in abundance. I think another point I would like to make is that I've been around IT organizations and tech shops for a very long time, and one thing that's clear to me is that the majority of tech talent are attracted to work and with tech. That's why they study computer science, engineering, data science, is because they like tech, they like data, and they like to work with tech. It's not that they want to work for a bank or they want to work for an insurance company or a manufacturing firm. So I think there are, opportunities, in respect of that. But I think also I think it presents a challenge, in terms of managing that talent in the sense that really, they are not too concerned about whether they're working for a bank or an insurance company. They really want to be working with tech. But to come to your question in relation to the personalization, and whether or not that I believe is possible, absolutely. And I go back, I think Sachin, he didn't use this phrase, but I think he alluded to it when he sort of suggested that perhaps insurance is really not sexy, and and in terms, particularly in its product offering. I think most of us would probably, if we had a choice, it's not something that we really feel that we need to maybe purchase. But then I kind of think about what I observe. And particularly this phrase that I really like, it's the phrase, what's the customer job to be done? And if we can really understand what's the customer's job to be done, and I think in my presentation I just gave the example of let's say a mortgage. It's not that the customer wants a mortgage. Yes, they do. But really, what do? They're looking to make it's a lifestyle choice. They're maybe looking to purchase a new home and a new apartment for example. So I think it's maybe trying to understand what's the customer job to be done. And this is why when I gave the example of USAA, and there are lots of other financial services companies beginning to focus on what are the customer life events. And I think, that this takes us to, and again, I think it was Sachin, talked a little bit about underwriting and the impact that tech was having on underwriting. And I see the big opportunity here is to look, again, at the customer job to be done. What's the data that's going to give us insight in respect of what the customer job to be done is? Because when I look at insurance companies, and historically they very often used what I would call surrogate data in making let's say underwriting decisions. And we can take the very, very simple example of motor, for example. It's generally where do you live, how old are you, maybe what type of a car you drive. It's basic surrogate data that the underwriters then use to assess your risk of essentially making a claim. I've never used data on my actual driving behavior. And of course we now know with the telematic based systems that we can begin to collect real data that actually indicates am I likely to be more likely to be in an accident or not. So I think absolutely, I think that, and then we can begin then maybe to personalize offerings to the customers based on data. And just to reiterate what I was saying during my presentation, that the capabilities of technology, no matter how sophisticated the technology actually is, the capabilities are pretty minimal. Collect data, store, transmit, manipulate, present. That's really it. And we're just limited by our ingenuity. So with the Internet of Things and sensors, can we now collect data that was previously either impossible to collect, difficult, or too expensive to collect? That maybe we can now collect that data, and that data can give us maybe greater insight into our customers, our customer problems. And again, we're seeing that, let's say, with a movement more towards prediction-based business models, for example, where we can now use the data to begin to predict, or indeed the prevention. Can we prevent customers making a claim, for example?
And Joe, I think just to build on that, I mean, I think also in terms of the use of data, there's also an opportunity to be a lot more inclusive around how we use data. I think, I think traditionally insurers have almost often used data as a way of trying to kind of focus on finding the healthiest customers to kind of keep the claims as low as possible. But actually we're in the business of protecting, a wider range of customers, and how do we use kind of data to personalize offers and onboard a wider universe of people as opposed to exclude. And I think that's, that's certainly kind of a real opportunity go forward as well.
I remember when I think it was the Cooperative Bank in the UK, they were, I think, one of the first insurers to offer telemetry-based insurance product, and they targeted at the the 17 to 25-year-old male, the typical boy racer. But part of the proposition was, was to, because essentially they realized as well that it wasn't the boy racer himself that was actually buying the policy, it was the parents. And they focused on trying to work with the parents in improving the driving behavior of the insured party. So I think again it's that maybe intelligent use of data and going beyond just it's a policy, it's a motor policy, but actually trying to add additional value.
Thank you, Joe. I have a question, an open question for you all. Upgrading legacy systems involves potential disruption to existing services, high development and migration costs, associated change management issues and costs. How do insurers balance the need to modernize while managing the costs associated?
That sounds like a pitch for Capco. Capco's services.
Or certainly a much better response from the COO in the panel.
Oh, thank you, Sachin. Much appreciated. Yes, I mean, there's always the balance between the need to continually invest, and I think that as we put technology into more of the forefront of the business strategies ahead, then clearly the continued investment is coming to the forefront as well. Now, I think we have some huge advantages as time moves on with technology, that not everything has to be bought as a capital expenditure and a large scale upfront investment, and a lot of it can be bought as services, and it can be bought as smaller services rather than huge investments as a one-off. So like I mentioned to the previous question, I think it's a case of breaking it down and continuing to invest where you need and modernize where you need, rather than wholesale replacements, which has been, I think, the historical way in which we've done things. So look, it still needs a huge amount of investment. Technology is apparently getting cheaper, although I'm not sure I'm convinced of that. But the widespread, more available, more innovative technology that's out there and consumable in a sort of SaaS-based model or a cloud-based consumable model, I think is helping us all.
Okay, can I just maybe make a couple of comments? I think the first one is that I think we just need to recognize that legacy is a characteristic of technology. Today's leading edge systems, we talk about AI and machine learning, for example. I can be sure if we're on this call in 5-10 years time, we'll be complaining about all those legacy AI systems. I think it's just a characteristic of technology, and I think it's it's particularly something that we see in financial services, insurance and banking, and I think that it's got to do with the past and particularly how we built systems. There is not one insurance company or bank that I'm aware of that does not want to be customer centric today. Everybody wants to be customer centric, but we got to remember that how we built systems in the past was either to be product focused or process focused. We never talked about customer centricity all those years ago. So I think that's we've got to remember that that those systems that are still with us, they're focused on products and process, and they're good at where they're focused, but not on the customer. So I think that's something that we also need to bear in mind. And I think the third point I would make is that we talk about legacy and we talk about legacy technology. I like to actually not see the issue as around legacy technology, but more about legacy decisions, because these are decisions. We made decisions, they're legacy decisions that we are actually living with now. And I think it's quite easy for, let's say, particularly those on the non-tech side, to look at technology and see the legacy is emanating from there. Well, they're actually kind of legacy, really business decisions. We as a business, we made this decision that is now with us. And I think maybe it's more fruitful going forward to see them as that legacy decisions rather than legacy technology.
I want to build a bit on this too, because I think it's a really important point, and something I think all of us struggle with, both in terms of what's the right balance of investment, but at the same time recognizing and building on some of what Professor Peppard said. This is also, a lot of our legacy is legacy because it's a highly regulated business. And there's very little regulatory harmony across markets right now there. And so the leverageability fundamentally of some of these technologies is not anywhere near where you'd like it to be for businesses like ours that are multinational businesses, right? We'd love to have one admin platform that we could deploy across 10 markets. We can't fundamentally, because by the time you meet the regulatory and local compliance requirements, you wind up having highly variant versions of that one piece of technology. So we do need to recognize that some of this is the industry. And I think in many ways, and this gets to the conversation around insurtechs too, there's high barriers to entry in this industry. We could complain about how unsexy it is, to use Professor Joe's words, and I'll embrace that here, but there's high barriers to entry, and these are some of them. It's the capital requirements, which have relatively low returns relative to a technology company or stock here. You have high regulatory barriers here too, that really do limit at times our ability to more efficiently use technology, which we'd like to do. And I can tell you, and I'm sure Bryce and Jon-Paul have their own stories, right? Sitting around the table as a CEO of businesses, we have lots of debates about how do we not do that here. And ultimately, there are tough calls that need to be made that often involve trade-offs around these points here. It is the nature of the business to some extent here. It's not to make an excuse to say we should therefore embrace legacy and have lots of legacy here. The final point I'd make, and this gets to the scale piece of this, I think fundamentally, I'm a big believer in scale is critical to create the kind of not only customer experience we're after here, but ultimately for those of us that are listed entities to also create a fair return to our shareholders here. And legacy in many ways is what comes out of being a successful scale business, right? And we need to recognize that as well here. But again, it can become a lodestone too to shifting the business model when we need to, but we need to, I think, often take away the negativity that sits around the word legacy. And I agree with JP, you got to unpack it and chip away at it one by one, because I've been around for a couple of the big replacement projects, and unfortunately neither one of them were successful. So I definitely agree that we've got to chip away at it, and that's probably the best way to do it.
Thank you. We've seen a trend in the last couple of years of more seed funding in terms of transformation, and to Bryce's point, agile value stream based projects rather than oil tanker type programs. Final question before we wrap today. We touched on customer interaction, especially in a COVID time, and different experience of customers. Are your client-facing teams allowed to converse or deliver a customer experience on the world's most popular communication channels, such as WhatsApp and WeChat? Or is that something you may consider in the future?
Maybe start on this one. So I think the convenience that is created by these platforms we can't ignore. However, the one point of concern is data transmission across those particular channels and our ability to remain responsible custodians of any customer information that we have. So there is a balance here in terms of what is possible. I think we are using these technologies in our company in order to capitalize upon the convenience with our customers, but we're also extremely careful about how we are using the technologies to remain responsible. And I would say also that it's not a case of picking one, whilst there's prevalence in each one of the countries that we're servicing around the region, whether it's Line or WhatsApp or WeChat, et cetera, and it changes through Europe and the States as well. So I think it's a case of building the ability to be able to link into many of these. What's popular today may be acquired, merged, or become unpopular tomorrow. And it's a case of when we do use these technology communication lines, making sure that we're not married to one or another. We keep it relatively generic. That's it from me, James.
Thank you, Jon-Paul. So big, huge thank you, hour 45 in, to all the panel members, Jon-Paul Jones, Allianz, Sachin Shah, Manulife, Bryce Johns, HSBC, and Professor Joe Peppard from MIT. On behalf of Capco, we will be donating a year's of girls' education to Room to Read, one of our global CSR partners, on behalf of each of the panel members and the professor today. And the recording will be made available via our website in the coming days for you to all to share. Thank you ever so much and have a wonderful evening.
Thanks
Thank you very much.
Thanks, everyone.